Hi, welcome. In this series of videos, we are looking to learn option valuation. This is one of the tougher topics in CA Final, CFA Level 2, and FRM Part 1. So the prerequisites for understanding the valuation of option is first, you need to understand what a call option is and what a put option is. Understanding a call option, the layman easiest way of understanding is call option can be seen as an upside betting. I would say just remove all inhibitions from your head when I use the word betting, because if there's something that can be made easily to understand you, I think this is it. Okay. I mean, if you understand option as a bet, I think that's the easiest way to actually understand. So call option is basically an upside betting. What do we mean by an upside betting? Let's say the strike price is 50 and the spot price at maturity is 60, right? I had an upside bet that the price of the share will be at maturity greater than 50, which stands true, right? The spot price at maturity is 60. So the holder of the call option wins the bet. He receives the differential, which means he receives 60 minus 50, which is 10. The writer has to pay the amount, which is $10, to the holder of the call option. If the spot price is on maturity is less than $50, which means I lose the bet, I don't receive anything. The holder does not receive anything. The writer does not have to pay the holder anything. Understanding put option, it's basically a downside bet, which means if the strike price is $50, I am entering into a bet that the spot price at maturity is going to be less than $50. For instance, if the spot price on maturity is say $37, which is less than 50, the holder of the put option wins the bet. Therefore, the holder of the put option receives $13 from the writer of the put option, right? So if I have bought a put option, I will always wish that it's a downside bet, which means I will always wish that the spot price on maturity is less than the strike price that is already known today. The third prerequisite is that you would have to know put call parity relationship, which means there's a relation between put option, spot price, strike price, and the call option. The put call parity states that the value of a put option plus the value of a share is equal to value of a call plus the present value of exercise price, right? I mean, if you've already learned, well and good. If you have not learned, it basically essentially tells you that if you have a portfolio which consists of a put, yeah, if you have a portfolio which consists of, uh, yeah, yeah, which consists of a put and a share, and you have another portfolio which consists of a value of a call and a bond whose payoff at future is X, which means the price of the bond today is the present value of X. So if you have two separate portfolios, both the portfolios will in future give you the same payoff, right? If there are two portfolios which give you the same payoff in future, then both the portfolios must have the same price today to prevent arbitrage. Simple thing. Let's say there are two assets, right? Asset one, asset two. Both of them have similar characteristics, same risks, everything. Asset one is going to give you a cash flow of 50 in future. Asset two is also going to give you a cash flow of $50 in future. Okay. Now, if I say that the price of asset one is 40 and the price of asset two is 47, right? The price of asset one is 40, the price of asset two is 47. And the cash flows for both of them on maturity are 50. The risks are the same, everything else is the same, right? Then don't you think there is actually mispricing? Because when the cash flow in the same is future, when the risk is the same, then both the assets should actually have the same price today, right? So either asset A, which is having a price of 40, is underpriced, or either asset B, which is having a price of 47, is actually overpriced, right? So if there are two, so coming to the prevention of arbitrage, so I mean, yeah, so sorry, if you have a situation where asset one is priced at 40 and the asset two is priced at 47, you can actually carry out arbitrage. I'll leave it to you as to how you would carry out arbitrage. That's going to be a future point of discussion for us as well later on, so I do not want to spend time here. But the prevention of arbitrage principle says that both the assets should actually have the same price today. Okay, so over here as well, it's the same thing. If there are two portfolios, one containing a put option and containing a share, and the other portfolio containing a call option and a bond whose face value is X. If the bond's face value is X, it's a zero coupon bond, by the way. If the bond's face value is X, the price of that bond today is going to be the present value of exercise price, right? Or the present value of X. These two portfolios are going to have the same payoff in future, irrespective of what the share price is going to be, right? So irrespective of the share price. So, whether it's zero, whether it's one, whether it's infinite, they're going to have the same payoff. If there are two portfolios which are having the same payoff, then the price should be equal. That is the reason we have equated both of them, saying, and that's called as the put call parity equation. We'll probably make a separate video in future, but the detailing on the put call parity is not the subject content of this video. Coming to the methods of binomial valuation, methods of option valuation. The first method is called as the single period binomial model, right? Within the single period binomial model, you have three different approaches. One is the delta hedging, the second is the portfolio replication, the third is the risk neutral valuation or expectations approach. Okay. Of course, there will be separate videos on each of these three topics because that is the main content that I want to give via these set of videos. But before I go on to the other methods of valuation, let's kind of deliberate on why is it called as binomial model, right? I mean, I've called it as binomial over here, right? Why is it called binomial? The model actually assumes two things. The first assumption is the share price changes only at the maturity of the option contract. What does that mean? In reality, actually, if you look at it, the share price is changing every second. The share price is changing based on each trade that takes place in the market, right? If a trade takes place at 50 right now, the share price is 50. The last traded price of the share is 50. If the next trade happens at 50.25, the last traded price becomes 50.25. If the next trade happens at say 47, the last traded price is 47. So the share price is actually changing every moment, right? Whereas this model, which is binomial model, single period binomial model, assumes that the share price changes only at the maturity of the option contract, right? It's an unrealistic assumption. Let's accept that, yes, but those assumptions will be broken down in future in the various other models that we actually see. Okay, and generally when people take assumptions, when all these guys who come up with these formulae, they take assumptions, it's more for the simplicity. For instance, even during IPCC, you must have learned the Modigliani-Miller model, where you assume that there are no transaction costs, no taxes, etc. That's because they would like to they do not want that noise to come in when they're actually creating a model. Here as well, it's completely unrealistic. Let's accept that. But this is going to become the base for the future models that we are going to see. Maybe, even if I explain it to you a little further now, you might probably not be able to appreciate it. So let's leave it at there. Okay, let's just take this as an assumption. Yes, all people work with assumptions, and this is one of the assumption. An unrealistic one, yes, let's accept that. The second assumption is, which is also very unrealistic, it says that there are only going to be two possibilities of share price at maturity, which means at the maturity of the option contract, the share price can either be this or it can be that. There cannot be any third possibility for a share price. Okay, so there are two assumptions. I'm repeating myself. There are two assumptions. One is the share price changes only at the maturity of the option contract, which means, let's say if the option period is 6 months, okay, I have an example here as well. Let's say if the call option maturity is 6 months and the current share price is $50. Sorry, give me a minute. Sorry, yeah. So if the current share price is $50 and the option maturity is 6 months, then binomial model is saying that the share price is going to change only at the end of the 6th month on the last date. Okay, let's say today is the 1st of January 2020. The share price will only change from $50 to some other value only on 30th of June 2020, assuming that's the 6-month period that we're talking about. The share price will only change on the 30th of June 2020, and the share price can actually only take two values, right? So from the 1st of Jan 2020 until the 29th of Jan 2020, the share price continues to remain what it is already, which is $50. And on the 30th of June, it can only take two possibilities, right? Now, what are those two possibilities? There's something called as upside factor and downside factor. Sorry with my drawing skills, guys. I'm working. I'm not good at pen either, and now it's worse because I'm working with a mouse. Um, so yeah, so the upside factor is 1.1. The downside factor is 0.9. Okay, so in this case, uh, basically what we're trying to say is the share price on maturity can be either 50 into 1.1 or 50 into zero point 0.9, which means the share price can either be 55 or it can be 45, which is 50 into zero point 0.9. So if you look at it, the share price today is $50. On maturity, we're saying that there are two possibilities of share price. One is 55, the other is 45, which is one greater than 50, one less than 50. Yeah. So I've just made a simple example. So I mean, this is actually an example for a further calculation as well, but I'll just explain it to the extent it is relevant over here. So the share price today, which is at t is equal to 0, t is equal to 0 always denotes today. Even in capital budgeting, I'm sure that you have used y equal to 0, which means years equal to 0, which is today. So t equal to 0, the price of a share is 50. At t equal to 6 or t equal to 0.5, 0.5 in the sense 0.5 years, 6 in the sense 6 months, the share price is either 50 into 1.1, which is 55, or it is 50 into 0.9, which is 45. Perfect. So yeah, generally, although I do not want to really pass a statement, generally, authors also take it. I'm writing, I'm not sure how it's going to come out, but yeah, fine. They also, to make their life easier, they actually use this assumption: d is equal to 1 by u, which I've not used in over here, by the way. If I'm not wrong, if you do 1 divided by 1.1, I think it's not going to be exactly equal to 0.9. Okay, but authors or international books actually use this assumption of d is equal to 1 by u. That makes their life easier. I'm not really going to go as to how it's going to make their life easier, but let just take it. I mean, for now, let's just take it that assuming d is equal to 1 by u makes it easier. And how have they arrived at this 1.1 and this 0.9? Again, I'm not really getting into that right now. I will probably maybe 4 or 5 videos down the line, I will come back and tell you how they actually arrive at 1.1 and 0.9. CA final, it's not relevant. CFA level 2, that's also not relevant. FRM part 1, I'm not really sure. It could be relevant for you. At least in CA final and CFA level 2, I'm sure that they will give uh, the U and upside factors and the downside factors in the question. Or rather, even worse, to make things easier for you, they're going to give you the share price, upside share price and the downside share price, right? Over here, upside share price is 55, downside share price is 45. The current share price is 50. Upper factor is 1.1, downside factor is 0.9. Next method, okay, so the first method that we actually saw was single period binomial model. The next method that we have is two period binomial model. Now, within the two period binomial model, you have the same approaches as earlier, which is delta hedging approach, portfolio replication, and risk neutral valuation or expectations approach. So within the two period, you again have the same approaches. Here, the assumptions are made slightly easier. What are we assuming? One, the share price actually changes twice in total. Okay, once exactly in the middle of the option contract and once at the maturity of the option contract. Okay, and the second assumption is there are going to be either 3 or 4 possibilities for share price at the maturity of the option contract. Okay, now I will just take this with an example. Let's again assume that the share price currently is 50. The option price, the option maturity is 6 months, which is t equal to 6. The upside factor is 1.1 and the downside factor is 0.9. Now let's look at the possible future prices. In two-period binomial model, the first assumption that we said is the option price, the share price can change twice during a period, during an option period. Once exactly at the middle of the option contract, which means once the share price is going to change at t equal to 3, which is 6/2, and the share price is going to change at t equal to 6, right? And there are 3 or 4 possibilities for share price. We'll come to that. So firstly, in two-period binomial model, I have the current share price as 50. At t equal to 3, the option price can either be 50 into 1.1 or 50 into 0.9. And sorry guys, give me a minute again. I'm sorry. Yeah, sorry. So at t equal to 3, option share price can be either 55 or it can be 45. And at t equal to 6, it can be 55 into 1.1 again, or it can be 55 into 0.9, or it can, so the way to look at it is, at t equal to 6, you already know what has happened at t equal to 3, correct? Standing today, you might not know what is going to happen at t equal to 3, but standing at t equal to 6, you already know what has happened at t equal to 3, right? So if the share price at t equal to 3 is 55, then the share price at t equal to 6 can be either 55 into 1.1, or it can be 55 into 0.9. Or if the share price at t equal to 3 is 45, then the share price at t equal to 6 can be either 45 into 1.1. You can also arrive this as 45 into 1.1, okay? Or it can be 45 into 0.9, which is 40.5, right? So now if you actually look at it, at t equal to 0, we have the current share price as 50, and there are 3 possible future prices at t equal to 6. One, 60.5, which is 50 has to get multiplied twice by 1.1. 50 into 1.1 is 55. 55 into 1.1 is 60.5. There is no other possible route to arrive at the value share price of 60.5. Or the second share price is 49.5. This can be arrived at 2 routes. One, 50 into 1.1 into zero point 0.9, which means 50, the share price goes from 50 to 55. At t equal to 3, the share price is 55, which means the share price rises. And then from 55, it falls back to 49.5, which means at t equal to 6, or from t equal to 3 to t equal to 6, there's a fall in share price of 5.5 rupees, or $5.5 in our case. Or the second route to arrive at 49.5 is $50 actually falls to $45 at t equal to 3. And at t equal to 6, the 45 actually increases to $49.5. Okay. And the last possibility, I don't know if you want to call this as the second possibility or as the second and third possibility. Sorry. And the last possibility, or which is the fourth possibility, or again the third possibility, which I'm not sure about. I mean, I'm not sure in the sense that you can, it's not like a hard and fast rule in the sense as to that you need to call it this way. But the way to arrive at it is 50 into 0.9 into 0.9. That's how you arrive at 40.5. So one, we saw that the share price is actually changing twice, once exactly in the middle of the option period and once at the maturity of the option period, right? And there could be 3 or 4 possibilities of share price at maturity of the option contract. In our case, there are actually 3 possible prices. One, 60.5, second, 49.5, third, 40.5. Okay, although 49.5 can be arrived at 2 routes, the upside and downside, or the downside and upside, it's still one possible share price at maturity, right? Now, when are we actually going to have 4 possible share prices? You will have 4 possible share prices when the upside and downside factors over here are not 1.1 and 0.9. Can we have 2 different upside factors and downside factors? The answer is yes. You can have one upside factors and downside factors over here. You can have another set of upside factors and downside factors between t equal to 3 and t equal to 6. Okay. Now, if I change this upside factor to, let's say, 1.2 and 0.8 hypothetically, just give me a second. Okay, I'll just do it over here. So what will happen is it will be 55 into 1.2 or the downside will be 55 into 0.8, right? So that these are the two possible share prices when at t equal to 3 the share price is 55. There could also be a possibility that at t equal to 3 the share price is 45. Now if the share price is 45, what will happen is the upside possible future share price at t equal to 6 will be 45 into 1.2, and the downside will be 45 into 0.8, right? So over here, you actually had a combining binomial model where both the upper side and the downside actually combine into a single value over here. Whereas when you take two different set of upside factors and downside factors, you do not have a combining binomial tree. Like you have seen over here, the upper share price coming from the bottom node, this each point is actually called as a node, N-O-D-E. So the upper node coming out from the bottom node, the upper node at t equal to 6 coming from the bottom node at t equal to 3 is actually greater than 44, which is coming from this side. I'm just rechecking that the numbers are correct. Into 0.8, into 1.2, into 0.8. Perfect, right? So if you have two different set of upside factors and downside factors, the only difference is you will have 4 possible share prices instead of 3 possible. And the reason is because it's not going to be a combining binomial tree, right? Is that going to affect your option valuation? To be answered, in the examination environment where you're using a pen and a paper, it's not going to impact the valuation of an option. Is there going to be an additional complexity because of it? Yes, there will be an additional complexity, obviously, because you have just one more extra node at t equal to 6. Earlier you just had 3 nodes, now you have 4 nodes. That's the only complexity that's going to get involved. Coming back. So till now, again, a quick recap. We saw there are 2 methods of option valuation so far, because there are going to be further methods as well. One is the single period binomial model. The second is the 2 period binomial model. Within single period and 2 period, you have same set of approaches: delta hedging approach, portfolio replication, risk neutral, or expectations approach. Now we understood the meaning of binomial. The reason it's called as binomial because bi means 2. There are only 2 possible share prices in a single period binomial. There are only 2 possible share prices that there are only 2 possible prices that a share can take, and the share can only change at the share price can only change at the maturity of the option contract. In 2 period binomial model, we made the assumptions slightly easier. The share price can actually change twice during an option period, once exactly in the middle, t equal to 3, and once exactly at the expiry of the option contract, t equal to 6. And there could either be 3 or 4 possibilities for share price at the maturity of the option contract. 3 prices where your upper factor and the downside factor are the same for both the time series, which means that you're using the same 1.1 in both the places. It could be 4 possible share prices where you're using different set of factors. Different set of upside factors and downside factors in the first time series and in the second time series. Continuing with the methods of option valuation, you have then the 3 period binomial. Guess what's going to happen? In 2 period binomial, we assumed that the share price can actually change twice. In 3 period binomial model, we'll say the share price can actually change 3 times during the option contract: 1/3, 1/3, and 1/3. Then we have the 4 period binomial model. The share price can actually change 4 times. At t equal, so let's say that you have an option contract of 1 year. The share price can change at t equal to 0.25 at the end of the first quarter, at the end of the second quarter, at the end of the third quarter, at the end of the fourth quarter. So if you're actually able to imagine, you will have 2 possible prices at the end of the first quarter itself, right? So 50 will either be 55 or 45 at the end of first quarter. From the first quarter, at the end of second quarter, you will again start calculating the upper nodes, the upper future share price and the downside future share price. That will be at the end of second quarter, from the second to the third to the fourth. So you will actually the number of share prices that you will actually have will be 2 power 4, which is 16, and over here it will be 2 power 3, which is 8. I'm sorry again, but yeah. So there will be 16 possible share prices provided you're using the same the same upside factor and the downside factor for all the time series. If you use different set of factors, different set of upside factors and different set of downside factors, you know what's going to happen? This 2 power 4 will actually get completely skewed, and it'll, you know, for instance, over here we just had 3 possible share prices, right? Am I actually right in saying this is 2 power 4? I'm just thinking. Okay, maybe I might, I will just check and come back to you if this is actually going to be 2 power 4. But essentially what I'm saying is, if you do not take the upside factor and the downside factor to be the same in both the time series, like for instance over here we took 1.1 and 0.9, over here we took 1.2 and 0.8, what you will end up having is, at the end of the option contract, which is at t equal to 1, you will have several share prices, because your binomial model is not going to be combining, it is going to be separate, and at each node you will have several possible future prices. So that's the most that's going to be the complexity involved in assuming that, you know, the U and D are different in each time series. And then from 4 period you can have 5 period, 7 period, 10 period, 20 period, and then you have infinite period binomial model. What do we assume in an infinite period binomial model? We assume that the share price can change every second. It changes momentarily, which is actually how it works in the real world, right? The share price changes every second. Okay. And there is going to be a possible share price. There are going to be 2 possible share prices at each second. Okay. Now imagine, like, at each second we're saying that there can be 2 different prices. And from that each share price, you're going to have further 2 prices, from that further 2, from that further 2, and so on. And you keep doing that every moment until you reach the option contract, right? Of course this is not going to be possible on a sheet, on with pen and paper. But then Black-Scholes, Merton, 3 people, they came up with something called as BSM model, which is Black, Scholes, and Merton, BSM. That's famously called as BSM model, which is a Nobel Prize winning model. Okay, so obviously when it's Nobel Prize winning, it has some weightage given to it. It's a closed form solution of option valuation. So what it does is, it basically throws an equation on your face, saying that this is the equation. You give the inputs, it will give you the output. The output is nothing but the value of an option. The underlying logic for the Black-Scholes valuation is the same. It's actually exactly the same as binomial model, just that it's assuming time period to be infinite, because I mean the time period is fixed, which is 6 months, but that 6 months is broken into infinitely small time periods, which is a moment. I shouldn't even utter the word second. They actually say momentarily the share price changes. Okay, so this is a part of our curriculum as well. It's part of both CFA final, CFA level 2 and FRM part 1. So we will be learning it. It's famously called as the Black-Scholes model. You can probably Google about it. I don't know how much of it you will be able to understand unless you're a math freak, but yeah, maybe you can try. Before we go ahead, let's go back to some basics of 11th and 12th. I'm probably going to touch an area which is a dangerous thing, which is mathematics of 11th and 12th. Okay, it's not going to be rocket science, I assure that. It's going to be simple basic mathematics. Even if you've forgotten that, I'm going to remind you, and in reminding you, you will not get a feeling of saying I've not understood anything, right? A straight line equation, okay, which if you remember what a straight line is, normal straight line, is in the form of y equal to mx plus c. I hope it's kind of ringing bells somewhere, that you might have read something like this. Even if it is not, no worries, right? So it's generally in the form of y equal to mx plus c. Over here, y is actually known as the dependent variable and x is known as the independent variable. Why are we calling it so? The value of y is actually depending on x, right? So if x takes some value, that will determine the value of y. So x is called as the independent variable, y is called as the dependent variable. The other words are, x is called as influencing because x is influencing y, and y is called as influenced variable because y is influenced by the value of x. What are m and c? M is called as the slope of the line. If you remember what slope is, great. If you do not, don't worry. And C is called as the intercept. Again, if you remember the meaning of intercept, well and good. If you don't, it's okay, right? Now let's take a very simple example, right? We all know that total cost is equal to variable cost plus fixed cost. Over here, total cost is actually y, because total cost is the dependent variable, and this is the uh, I would say the independent variable component. I will exactly, let's take it in the form of a general math equation where y is equal to 7x plus 50,000. If you actually look at it, 50,000 is your fixed cost. Okay, I will tell you why I'm saying it's fixed cost. X refers to the number of units produced. 7 is the variable cost per unit, right? X is the number of units produced. 7 is the variable cost per unit, which means for every extra unit produced, you will incur 7 rupees or $7 additional cost. And Y is total cost, which is the dependent variable. So the total cost is actually dependent on the number of units produced, right? So Y, the dependent variable, is total cost. X, the independent variable, is number of units. The number of units produced is going to determine the total cost, or the Y, right? Now, what is the meaning of slope? We saw that m is equal to slope, and m in this case, if you purely compare this equation, m is actually equal to 7, right? What is the meaning of this slope? If x changes by 1 unit, how much does y change by? That is the meaning of slope. In sleep also, if I wake you up and ask you what the meaning of slope is, you should come back and tell me that slope means if x changes by 1 unit, if the dependent variable changes by 1 unit, how much will the if the independent variable changes by 1 unit, how much will the dependent variable change by? I actually told you that in sleep you should be able to tell me. While being wide awake, I myself goofed up. Okay, sorry, but yeah. If x changes by 1 unit, how much does y change by? In our example, x was actually nothing but the number of units, right? If the number of unit changes by 1, which means if I produce 1 extra unit, what is the additional, I mean, how much is the y going to change by? That is nothing but our variable cost per unit, right? Which is 7, sorry. Um, Yeah. So if x changes by 1 unit, y is going to change by 7. 7 is nothing but a variable cost per unit, right? 1 extra unit produced will result in a total cost, or an increase in a total cost by $7. So over here, the slope is actually 7. M is equal to 7. Just repeating myself. What is the meaning of slope? So in a straight line, rather, y equal to mx plus c, m is actually the slope of the equation. What is the meaning of m, or slope? If x changes by 1 unit, if the independent variable changes by 1 unit, how much is the dependent variable going to change by? That's the meaning of slope, right? Over here, in a straight comparison, you're able to actually see that m is equal to 7. But even if you were not, even if I wouldn't have given you this equation, and if I would have told you that, just take uh, sorry yeah, sorry for that disturbance. If I just take y equal to 7x plus 50,000, and if I tell you that 7 is the variable cost per unit, if x changes by 1 unit, then you know that the y is going to change by $7. If I cut my production by 1 unit, the total cost comes down by 7. If I increase my total production by 1 unit, the total cost goes up by $7. Now coming to what is the meaning of intercept. C is the intercept over here, and by comparison, you know that 50,000 is actually the intercept. Intercept actually means if the value of x is 0, what is the value of y? Repeating myself, if the value of x is 0, what is the value of y? Which means if I produce 0 units, I am still going to incur some cost. What is that cost? It's 50,000. Just put 0 in this equation. Y equal to 7 into 0, which is 0, plus 50,000, which is 50,000. That is nothing but the fixed cost, right? Because fixed cost does not depend on the number of units produced. Fixed cost is going to remain fixed whether you produce 0 units or whether you produce 10,000 units, right? So if you also see over here, 50,000 is not getting influenced by the number of units. Number of units meaning X. It's independent of the number of units. But it is still influencing Y, yeah? So this 50,000 refers to the fixed cost. So in the equation y equal to mx plus c, m, which is slope, means if x changes by 1 unit, how much is y going to change by? And the meaning of c, which is intercept, means if the value of x is 0, what is going to be the value of y? I think I've made it fairly easy by bringing something like total cost equal to variable plus fixed cost. Of course, our future examples are not going to be oriented towards this, but I can assure you that this intercept is not something that we are going to dig deeper into. The only thing that we are going to dig deeper into is the m, which is the slope, which is 7, right? So m, or slope, again is nothing but if the value of x changes by 1 unit, how much is the value of y going to change by? So detailing slope. I hope, by the way, I've not scared any of you with the mathematics here. I think it was fairly easy. Okay. Now the next question is how do we actually calculate slope? Over here, we were actually given the equation y equal to 7x plus 50,000. And obviously it was clearly seen that slope is 7. Now, if I don't give you the equation, and if I give you 2 points of x and y, if you remember, we used to have a graph like this, and I gave you 2 points. You can still construct the equation. I do not know if you remember it or not. I'm not going to ask you to do it. I'm not going to remind you of it, right? But basically, if you know 2 points which satisfy the straight line equation, then with these 2 points, you can actually draw the straight line, and you can okay, sorry, let's say that point was this, and you can actually find out the equation of this as well, right? You can find the equation of that. Okay, but I'm not getting into that. All I'm getting into is how will we calculate the slope if you're not given the equation, but given 2 points of x and y which fit that equation. Let's say x equal to 1000. Okay, because you know that equation, if you're able to remember, it is 1000 into 7 plus 50,000, which is 57,000. And if the number of units are x, which is 10,000, it is 10,000 into 7, which is 70 plus 50, 1,20,000. Okay. But assume for now that you do not know the equation, and these are just 2 points which fit that equation. The slope can be calculated using this formula. I hope by just seeing this formula, you're able to recollect something. Even if you're not, it's okay. But I just want you to know that slope can be calculated as y2 minus y1 divided by x2 minus x1, which is 1,20,000 minus 57,000, which is about 63,000, divided by 10,000 minus 1,000, 9,000. So 63 by 9,000 is equal to 7, which is the same as what we actually got earlier, right? So what I'm essentially trying to say is there are 2 ways of calculating slope. One, if I throw an equation on your face, which is y equal to 7x plus 50,000, you can just straight away tell me that the slope of the equation is 7 just by seeing the coefficient of x, right? That's called as the, like we have, that's called as the, it has a technical name. I'm just forgetting it. Anyways, it's okay. Yeah, okay. And then the second way is where you do not have an equation. You can actually calculate, it's called is the coefficient of x or something. Yeah, I'm sorry. I'm not able to exactly remember, but it's basically the coefficient of x. Over here again, yeah. So if you're given 2 points which satisfy the equation of a line, then you can calculate the slope of the equation by using this formula y2 minus y1 divided by x2 minus x1. Now this you don't have to really know, but it's great if you know. And it's only for the math freaks. The slope is actually the first derivative. I'm not talking about SFM derivative. I'm talking about dy by dx of mathematics, 11th and 12th. Okay, it is the first derivative of any equation. Okay, just the basic, we had y equal to 7x plus 50,000. If you differentiate y with differentiate the equation y, this y equation by x, you have dy by dx. Okay, I don't know how many of you will remember. D by dx of ax is actually a. Okay, where a is a constant, right? So d by dx of 7x is 7, and d by dx of any constant is 0. Okay, d by dx of ax is equal to a, and d by dx of any constant is 0, right? Actually, it should be d by dx. It's not dy by dx, because dy by dx is on the LHS, right? I'll make that change on the slide as well. Okay, it's good if you are able to actually remember at least this basic. I'm not going to go into differentiation beyond this, but basically what I'm trying to say is dy by dx is actually the slope, which is equal to 7 plus 0, which is 7, right? So there are three ways of calculating slope. One, I give you an equation, y equal to mx plus c. You straight away look at the coefficient of x, which is 7, and tell me that the slope is 7. Or two, I give you 2 points on an 2 points which satisfy an equation, and you can calculate the slope as y2 minus y1 divided by x2 minus y1. Or the third method of calculating slope is take the first different derivative or the first differentiation of the equation, right? You might ask me, sir, when, okay, I don't know if you'll call me sir, but if the first and the second method are so easy, why are you actually taking us to the differentiation or the derivation of this equation? The answer is the first and the second method are going to work only and only and only if it is a straight line equation, because only a straight line equation is going to have the equation of y equal to mx plus c. For instance, for example, I don't know you if you guys are already done with fixed income. The equation of a bond is actually a curve. It is not a straight line, right? It's a curve. And you also realize that it's a curve because the price of a bond is equal to cash flow 1 divided by 1 plus r plus cash flow 2 divided by 1 plus r the whole square plus cash flow 3 divided by 1 plus r the whole cube. Okay, over here the price is the dependent variable. Okay, the P0 that is there on the LHS is the dependent variable, and R, which is your discount rate, is the independent variable, right? Okay, the fact that R, over here, your independent variable, which is X, has the degree of 1. It is X raised to the power of 1. Whereas in the equation of bond, R has in the denominator it is divided by 1 plus r divided by 1 plus r whole square divided by 1 plus r whole cube. So r does not have one is it's r is not a single degree equation. It's basically r raised to the power of 2, r raised to the power of 3, which means it's not a straight line. By that itself you actually get to know that it's not a straight line. So in that case, you can, if I ask you to identify slope, you will not be able to identify the slope of it because it's not going to be a one single form of equation, right? R is going to have multiple coefficients, and R does not have a degree of 1 either. Okay, so that is the reason, that is where this using differentiation of mathematics actually comes into play. Okay, now coming to the first method, or the delta neutral method. If you remember, under single period binomial model, we had delta hedging. Okay, that's called as the delta neutral or delta hedging method. Both of them are the same under the single period binomial model. Okay, what is the meaning of delta? Now you must have actually wondered, why the hell am I actually teaching you slope and intercept and rubbish? Does it have anything to do with what we're going to learn? Yes, it does. Meaning of delta, the word delta over here, you should first understand that, right? What does delta mean? Okay, before that, you might already know this, but I'm just reminding you again. An option derives its value from the share. That is the reason why it's called as a derivative, right? It's deriving its value from an underlying asset. The option derives its value from a share. If you look at it closely, option price is actually the dependent variable. Share price is the independent variable. The share price is going to influence the value of the option or the option price, right? So all that we learned, y and x, is actually going to be relevant over here, because over here y is the option price, which is dependent variable, and x is the independent variable, which is the share price. Okay, and delta actually means if share price changes by $1, how much is the option price going to change by? Okay, if share price changes by $1, how much is the option price going to change by? Give me a second, guys. I'm getting a call. Yeah. So the meaning of delta is if the share price changes by $1, how much does the option price change by? If you actually remember, this is actually nothing but the definition of slope. If the independent variable changes by 1 unit, how much will the dependent variable change? Over here, if the share price changes by $1, which share price being the independent variable, how much does the option price change, which is nothing but the dependent variable, right? So delta is nothing but the slope of the value of option. What are we trying to say? So the value of an option is actually going to have an equation, correct? Just like how bond pricing has an equation, which is cash flow divided by 1 plus R plus cash flow divided by 1 plus R whole square, blah, 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 blah. Option pricing is also going to have an equation. Delta is actually going to be the slope of that equation, right? So again, delta means if the share price changes by 1 unit, how much does the option price change by? So delta is nothing but slope, and the delta is nothing but the slope of the value of option, and the value of option is going to be an equation. Okay, and just to remind you, a passerby referencing, beta, which you learned in equity, is also the slope. If you remember the definition of beta, it is if the return on market changes by 1%, how much does the return on share price change by, right? Which is nothing but market is the independent variable, and the return on share price is the dependent variable. If the market changes by 1%, how much does the share price or how much does the return on share price change by? So beta is also nothing but the slope of the equation, where the equation is between the return on market and the return on security. Okay, and even so is duration. If you remember, I said in the previous slide, price is actually the dependent variable, and R, which is the discount rate, is the independent variable, right? And the definition of duration is if the discount rate changes by 1%, how much is the price going to change by, right? And that is nothing but the slope. That's nothing but the meaning of slope, right? So what beta is for stocks, duration is for bonds, and delta is for options. Okay, this part, even if you do not understand, that's fine. Maybe in the future course of time, when I make separate videos on that, we'll deal with it. The only thing over here is delta is not constant. Delta itself keeps changing. And the reason you might probably find it a little difficult to understand is, over here we had a straight line equation where y is equal to 7x plus 50,000. 7 is always going to remain as is until, of course, hypothetically you can say that what if there is inflation and the cost of unit changes and all that. I'm not talking about that. But so long as other things remain constant, 7 is always going to be the variable cost per unit, right? But over here, the delta is not constant. The delta itself keeps changing, right? For now, I would say just digest this fact. We'll come back to this later as to how delta is changing, okay? And the reason for this is the fact that uh, the equation for value of an option is actually not a straight line equation. Like y equal to 7x plus 50,000 was a straight line equation. This is not a straight line equation, right? This is also, like bond, a curve. Okay, and if there is a curve, then the slope keeps changing, right? Okay, we'll probably get into it a little more later, but when you have a curve, the slope always keeps changing, right? And that's the reason, even if you've done fixed income properly, duration is never constant. Duration by itself keeps changing based on the rate of interest. Here as well, delta is not constant. Delta itself keeps changing based on the change in share price. Okay, now coming to an example that we took earlier. Okay, so see, let's say in single period binomial model, we had t equal to 0 where the share price was 50, and at t equal to 6, we said the share price can either take the value of 55 or 45, right? Let's assume that the strike price of an option is 48. Okay, now over here, the payoff of the let's say this is a call option. Okay, I'll add that as well. Okay, if this is a call option, the strike price was 48. On maturity, the share price is 55. Okay, therefore the option payoff is 7. I've put an equation, no rocket science. I've just put a equation so that it auto calculates. And over here, the payoff is going to be 0, right? Okay, now I told you over here that if I'm given 2 points which fit an equation, I can calculate slope as y2 minus y1 divided by x2 minus x1. Okay, over here, I again told you that y, which is the dependent variable, is the option price. X, which is the independent variable, is the share price. Okay, So X is the share price, which is 55 and 45. Independent variable is 7 and 0, right? So if I'm given 2 points, which I am, 7 comma 55, okay, let's say this is this is x1 and this is x1 and this is y1 and this is x2 and this is y2. So I'm given 2 points. I can calculate the delta, or I can calculate the slope. Slope is nothing but delta, by doing y2 minus y1 divided by x2 minus x1. And that's going to be equal to 7 divided by 10, which is equal to 0.7. So the delta over here is 0.7. Okay. Now, a simple question that you might come up with is, I said the value of an option is not a straight line equation, and y2 minus y1 and x2 minus x1, this equation can only be used for a straight line. The reason is, binomial actually is a straight line form of equation. When you further go into when you dig into binomial and arrive at the Black-Scholes version, it is in Black-Scholes model that the option price is not really regarded as a straight line equation, but in binomial model you can still say that the option valuation is more or less a straight line form of an equation. Okay, so the delta over here is 0.7. If I go to the second example where we had a 2-period binomial model, okay, we so what we said was the share price can either be 60.5, 49.5, or 40.5, right? So let's say I'm standing at here at t equal to 3, okay, and I would like to calculate the delta of the option based on two possible prices, which is 60.5 and 49.5. If the price of the share is 60.5, the option payoff is 12.5, where the strike price is 48. And if the share price is 49.5, the option payoff is going to be 1.5, which is 49.5 minus 48. Okay, so I am standing over here. When I'm standing over here, what happens at the down node is actually irrelevant to me, right? What is going to be relevant to me is only these two. Okay, again, like I said, we have this as x1 y1 and this as x2 y2. Okay, and if you actually see, okay, I'll delete, okay, maybe I'll just keep it over here. Okay, it's going to be equal to equal to y2 minus y1, which is 12.5 minus 1.5, the whole divided by x2 minus x1, which is 60.5 minus 49.5, and it's going to be 1. The delta is going to be 1. Okay, if you actually see in a single period binomial model, when we were standing over here, the delta of the share was 0.7, which means I said that if the share price changes by $1, the option price is going to be going to change by 0.7. Okay, and if you actually look at it, let's say there are two possibilities for a share price, right? 45, 55. If the share price changes by $10, which is 45 to 55 is $10, the option price is changing by $7, which means 7 divided by 10 is 0.7, right? If the share price changes for every $1 increase, you can actually think of it as the delta is actually, if the call option price is changing by, or did I say call option? Yeah, okay, fine, yeah. It is going to change by 0.7. In a 2-period binomial model, for the same set of values that we had over here, what I just did was we extended that binomial model. The delta has changed to 1. Okay. And if you actually see, that is the reason I actually said delta is not constant. Delta itself keeps changing. And the reason for the delta changing is the change in share price. In the first equation, in the first method, we had a current share price of 50. In the second equation, the current share price became 55. And that is the reason we had a delta of 1. Okay. And if at the second node, if you assume that the share price was actually not 55, but was 45, let's again recalculate the delta. So standing at 45, you have two possible prices, 49.5 and 40.5. And you have two option price payoffs, which is 1.5 and 0, right? So again, this is x1, y1, and this is x2, y2. And if you actually put this formula equal to 0 minus 1.0 minus 1.5, the whole divided by 40.5 minus 49.5, it's going to be, what just happened? Okay. 0.17, right? So the delta in a single period binomial model was 0.7 because the share price was 50. When the share price increased from 50 to 55, the delta became 1. When the share price came down from 50 to 45, the delta became 0.17, which means the interpretation of 0.17 over here is, if the option price change, if the current share price is 45, and from the current share price, if the share price changes by $1, the option price is going to be the call option price is going to go up by 0.17. Okay, that's the meaning of delta over here. Over here as well, if the current share price is 55, and if the share price changes by $1, the call option price is going to change by $1, which means if a share goes up by $1, the call option will go up by $1. If the share goes down by $1, the call option will go down by $1. The fact that what is it called, the I mean, before one we do not have a negative signage, we have a positive signage that shows that both share and the option are actually going in tandem, which means if share increases, option value increases. If share decreases, the option value decreases, right? So positive indicates the same direction. Negative, if it was, would indicate opposite direction. For instance, in a put option, you're going to have negative delta, which means if the share price increases by $1, the value of put option will fall, right? Technically also, if I have a strike price of $50 and the put option is goes from 50 to 51, I mean, let's say the current share price and the strike price are $50, and the share price increases from 50 to 51, the put actually becomes a little, cheap in that sense, right? So, I mean, the value of put option should fall, right? If the share price falls, the put becomes in the money and the value of put option should rise. So the share price and put option have negative relationship. Okay. I would end this video because the video is getting longer, but we will actually get into delta neutral method in the next video. I hope you have understood what the meaning of delta is. Even if you have not, I would say it's okay. Do not keep watching the video the third time or the fourth time, because going ahead, you will actually understand it for yourself. Okay. Thank you guys. Bye.